Okay, welcome back. We're going to be doing part 2 of debits and credits, and we're going to basically do what we did last time with the accounting equation, but we're going to add revenues and expenses. Look at the full accounting equation. We're going to do the journal entries and T accounts as well. Okay, let's go ahead and get started. So I've done some pre-writing here because I want to remind you that I had used the basic accounting equation, which is this: assets equals liabilities plus owner's equity, or I typically just shorten it to equity. But we need to take into account the other three types of accounts. There's revenues and expenses and drawings. The first three that we dealt with are on the balance sheet: assets, liabilities, and equity. So we want to know, we already know that for assets, if we took these as T accounts, that assets, the debit side is the positive side. The liabilities, the credit side, is the positive side. Equity, the positive side, is the credit side. We learned that in the last time. Now what we want to do is fill in what is the debits and credits for these three. So let me remind you of sort of the logic train about how and why revenues get put into the equity. So if revenues go up, that kind of means net income goes up, all else being equal. If net income goes up, ending owner's capital goes up, and then the owner's capital goes into equity, meaning the equity goes up. So essentially what we're saying is revenue, as revenue goes up, so does equity, meaning revenue sort of acts like equity. An increase to revenue is, after you follow it all the way through all the financial statements, is an increase to equity. So we're going to say that it behaves like equity, therefore on the debits and credits, it will be like an equity. Now, expenses and drawings are both situations where cash is leaving the company. Expenses are for like rent or utilities or wages or things like that. Cash is leaving. That reduces net income. That reduces ending capital, and therefore that reduces equity. So we're going to say expenses work the opposite way. So anything, a credit increases revenue, a credit increases equity. Therefore, what decreases equity? What decreases equity is a debit. So an increase in an expense is the same as a decrease to equity. And drawings are the same. Now, it's money leaving the company, but for a different purpose. It's not for day-to-day operations, which is what expenses are for. Drawings are for when the owners take out money from the company. And it will behave very similarly to an expense. Now, it seems complicated, and I agree with you. It's a little fussy here. But what I can do is say there are 6 different types of accounts: assets, liability, equity, revenue, expenses, and drawings. And we'll learn different names for drawings. For corporations, they're called dividends. But notice we have 3 accounts, so we only have 6 accounts. That's as much as we're going to have. Now, we'll have a bunch of sub-accounts like cash or inventory or equipment, but these are the 6 main categories. Now, notice there are 3 account categories: assets, expenses, and drawings, that are increased with a debit. And then there are 3 liabilities, equity, and revenue that are increased with a credit. So we've got 3 of each. We have 6 accounts. 3 are increased with a credit, 3 are increased with a debit. Now it takes a little bit of practice to remember which ones are which, but just realize it's 6, but there's not more than 6. So once you get these 6 down and realize it's 3 of one and 3 of another, it's not that much. In fact, you could probably just memorize assets, expenses, and drawings and realize anything else is going to, as a debit increase, anything else is going to be a credit increase. So not to get overly fussy, but this is part of those rules that you have to learn. But once you do, you don't have to, there's not like more accounts out there that we need to memorize. These are the 6. Well, what we're going to do is what we did in the last video is we're going to look at a couple of more business transactions and see if we can line them up and make sure we understand what the debit and credit effect is. So here I'm going to keep numbering 6. Let's say we make a sale of inventory. Make a sale. So we're going to sell some of our inventory, and that the retail price is going to be $600. Now, and this is going to be a make a sale in cash. Well, the customer is going to be giving us cash. So that's going to be an increase to cash of 600. So that's a debit to cash. And then if I just looked at that and said, okay, cash went up by 600, but we don't know why. We don't have the other part of the transaction that tells us why. Anytime you see the word sale or customer or something that relates to them, you have to remember we need to record revenue. Without recording revenue, that doesn't get into our income statement. Just recording the cash part is not enough. You have to explain why did cash go up? Because cash could have gone up from we took out a loan. It could have been an investment by an owner. Not until we put this down as revenue, 600, do we know where the cash came from or why we got the cash. Now remember, revenue is increased with a credit. So this would be a credit to revenue of 600, a debit to cash of 600. So you notice my debits and my credits equal. And I won't write them all out on the debits and on the T accounts. We kind of looked at that last time. And what I will do in part 3 is I will list all of these with their journal entry as well. So let's just keep going through, and I just want to be able to explain the reasoning for the first 5 transactions where we use the basic accounting equation. Those are a lot more straightforward and easier to see. The ones where we deal with revenues and expenses are not quite as understandable. So I'm just going to, without, I guess, distracting us, I'm just going to focus on explaining those so that we can see what's going on. So number 7, we need to, we recorded the sale, but we also sold the inventory. So the inventory, we need to write down, we sold the inventory, and what was the wholesale price? What did we buy the inventory for? The wholesale price was $300. So when we record a sale, especially if we're selling product, if we're selling something physical, there are going to be 2 parts to a sale. There's going to be the revenue part, which represents the cash that the customer gave us. So that's the customer giving us. Now, what did we give the customer? We gave the customer some of our inventory. Now, we're not telling them what our wholesale price is. Well, maybe they know, but that's not the point, is that we don't record the sale as a sale of a $600 item, because then if we sold a $600 item for $600, there'd be no profit. What we did was we bought something for $300 and we sold it for $600, and our profit's going to be the difference of that. So what ended up happening? Well, we give up the inventory. The inventory goes down, so that would be a credit to inventory of $300. And anytime, and this is an important thing to understand, and I would say expenses are sometimes hard to understand, and we'll pay a little bit more attention to them. Anything that we use, anything that we give up to create a sale. So the sale was a $600 sale, but what did we give up in exchange for that $600? We gave up $300 of inventory. So why did the inventory go down? This is what we gave up. And so we're going to call that an expense. And in fact, there's a special name to it, and I'll put the name here, but we don't have to know it quite yet. It's called the cost of goods sold. And so it's going to be $300 expense, and we have a credit of inventory, therefore we need a debit. So notice that an increase to an expense is a debit, so this works out fine. What ends up happening is when we translate these, when we transfer these to the income statement, we'll have a $600 revenue item, we'll have a $300 expense item, and therefore our net income will be $300. So this is a sale where we've sold something physical, right? Let's just do a sale. Perhaps we perform some services. Now, there are going to be some expenses for services, but there will probably be wages and that sort of thing, or salary. So we're not going to directly address the expense, because I want to address something slightly different with this. Let's say we have a sale where we perform a certain amount of services, SVCS, that's my abbreviation for services, but we do it on account. Now remember, when we purchased inventory account, that was an accounts payable, an account for cash to be paid later. But here we perform services on account, and this is going to be, let's say it's $700. Well, first of all, we've done something. We've made a sale, basically. We have service revenue. So I'm going to credit revenue of $700. But we haven't received any cash, have we? What have we received? Well, this is sort of the reverse of us buying inventory on account. We get the inventory and we basically give the vendor an IOU. So the reverse of that is here we've performed some services and now our customer has given us an IOU. Well, what do we call it when a customer gives us an IOU? When our customer promises to pay us later. We call that an accounts receivable. And this is an asset because basically it's an IOU that we hope will turn into cash soon. It's like it's the cash, we just don't have the cash yet. So if an accounts payable, if I said the long form, I said it's an account for cash to be paid later. An accounts receivable is an account for cash to be received later. AR. So and this is going to be a debit because it's an increase of an IOU. It's an increase of an asset. So my debits and my credits equal. Let's look at one more. We're going to look at two more. Let's look at the next one. We pay rent. And rent is going to be $200. So this is going to be paying rent in cash. So paying rent in cash is a credit. It's a decrease of an asset, a credit to cash of $200. And what is my debit? Again, here is a situation where it's hard to tell about expenses because sometimes they're not very obvious how they are. But once you get in the swing of it, you'll understand it. Rent is part of our day-to-day business transactions. It's not exactly like inventory. We didn't give up rent to make the sale, but you have to think about what are all the other necessary day-to-day business things that we need to do to run our business, to generate revenue. Well, we have to have employees, we have to have the lights on, we have to have a place to work. So rent is another type of expense. So expenses go up through a debit. So we're going to debit an expense for $200. And this would be a rent expense. The last one we're going to look at is, because this is probably a sole proprietorship or maybe a partnership or something like that, maybe it's an LLC, we could write it up as paying ourselves a salary. But because maybe we're the only person or where there's only like a couple people, at the end of the month, perhaps what we do as the owner is we just take some money out of the company as to pay ourselves, as living some cash that we need for living. So we're going to draw, let me see, how much did I say I was going to draw? I'm going to draw 400. So again, cash will go down by 400. And this will be this last category here, draw. Now it acts the same way as an expense. So we have a credit to cash, therefore we have a debit to a draw of 400. Okay, I imagine you'll probably want to look at this again, but that is 5 business transactions just using the basic equation, just assets, liability, and equity, and then 5 transactions including the revenues, expenses, and draw. I'm going to combine all these and we'll look at this in part 3.